The seasonally adjusted Kagiso Purchasing Managers Index fell for the second consecutive month, declining by 1.4 index points to reach 53.7 in April this year. This is said to be happening due to a slight easing in demand. Joining us now, Abdul Davids, Head of Research at Kagiso Asset Management. Abdul, good to have you with us in the studio in Joburg. Of course, you're from Cape Town. Tell us about the drop in the April month, because of course we have seen this trend which started in March, but what caused this month's drop?
I think one of the big components is the new sales orders. That declined by about 4 index points, and that has the biggest weighting in the overall PMI composition. We've also seen expected business conditions decline by about 6 index points as well. And I think the combination of those two really drove this result. What we've also seen is that this number at about 53, as you've said, is lower than the average for the first quarter of about 55. And we've seen this trend where the last quarter of last year, the fourth quarter of last year, we've seen an average of about 50.5, increasing by almost 10% to 55 for the first quarter of this year, and now moderating to about 53. And we believe that that's an indication of things to come. We've seen
it's very worrying if you say that, putting it into the global context, because we had Eurozone PMI data coming out this morning and showing that manufacturing activity is sitting at the lowest level it's been since June 2009. And many economists have been saying that going into quarter two, that's when we're going to start seeing the effect of Europe on local economic data. Is that, would you be in line with that view?
We'll concur with that view. What we have seen is an element of restocking in the first quarter. We've seen some of the players in the auto sector, for example, retooling their kits. We've seen some of the steel makers also restarting furnaces and steel plants as well. And all of that impact on demand, as we have seen come through in the first quarter already, that we believe now is in the base. So from here we need to see a recovery in demand and actual in demand to see the continued momentum in our purchasing managers indices.
Because there was a lot of optimism about the recovery that we were starting to see in the local manufacturing sector. So was that a temporary pickup in the manufacturing sector? Did we get a little bit too excited about the recovery we were seeing?
Unfortunately, it looks like that is the case. If one looks at the sub-indices, for example, expected business conditions hit a peak in February this year. It has started to come off now. So clearly what managers are seeing is that a softening in conditions going forward. That normally looks at least 6 months. So they are looking at a moderation in demand coming through, and as a result, they're tempering their orders as well. Now that impact we've seen, as I've said, was mainly driven by restocking. We haven't seen final demand pick up yet, and unfortunately, until we see that final demand picking up, that will probably remain for the next couple of months as well.
Let's talk about the pricing element, because that pricing index has in fact come down. But there are a lot of pricing pressures we know are evident in the economy right now. If you're living in Gauteng, you're paying over 12 Rand for a litre of 95 petrol. That's going to hurt the bottom line of businesses, especially transport companies and those involved in the logistics chain. Electricity prices went up in April. So what is the outlook for prices at the factory gate?
We have seen a moderation in PPI numbers as well that was released previously. However, if you look at petrol and diesel prices in particular, it can be between 25 and 35% of manufacturer's cost as well. So clearly a moderation in oil prices. We have seen a slight moderation in oil prices coming down from their peak. It has been quite volatile. We have seen some rand strength coming through as well, even though the rand has been quite volatile. But we really need a sustained decline in petrol or oil prices in dollar terms, and also moderation.
What would be a sustained, because it's $119 a barrel right now. So what type of level would indicate that we're going to have a substantial drop in PPI numbers?
I think what manufacturers in South Africa have done is they've been very good at adjusting their cost bases for higher levels of oil prices. Having said that, if we see a momentum or a shift downwards in terms of oil prices, that will have a massive positive impact on their cost line as well.
Do you have a level there that would be kind of...
Probably $100.
Yeah, $100. I suppose everyone wants a lower level.
20% decline is probably where we need to see it.
As you say, it was 126. It hasn't come back that sharply, but still lower than that. You mentioned the currency, and Stuart Jennings, who heads up the manufacturing circle, indicating that the volatility in the currency is a big problem, and of course the persistently strong rand, because it makes local exports uncompetitive globally. Have you had do you have any thoughts on the impact of the rand at these levels?
Yes. What we have seen anecdotally, I mean, we speak to manufacturers continuously, and what they typically say is the worst thing for them is actually volatility. The actual level of the rand, they can always adjust their cost basis depending on where the rand actually settles down in. But the volatility makes planning very difficult for them. Having said that, what we have seen, actual levels of the rand between below 750 to 720, for example, is typically where export and import substitution happens, and manufacturers are impacted by that as well.
So not quite at that level, but 50 cents off that level.
That's right. I think we have seen over the last couple of years manufacturers being very good at adjusting their cost basis for a stronger rand environment as well. well. But obviously the volatility in the near term is what is impacting them as well.
What about the employment situation right now? Because the employment index still sitting below 50 at 48.8. That means that the sector or employment is still in contractionary mode, still shedding jobs.
Right.
Anecdotally, of course, you're also speaking to manufacturers. What is their situation with regards to employment and job creation in light of government's plans?
I think what we have seen over the last couple of years is we've actually had excess levels of labor, if I can call it that. And with the moderation in PMI numbers that we've seen and activity levels as well, there hasn't been a need to employ more people. And as a result, we have seen this contraction going back to about January 2010 as well. We need to see a sustained level of increase in activity levels to see job creation coming through and that index going above 50.
Is there a sense also that manufacturers are moving towards automation, of course, to cut costs?
Very definitely. I think we have seen in certain manufacturing sectors, AECI for example, they've opened a new plant, fully automated. You've got all these robots manufacturing explosives, for example. That plant used to employ about 250 people. Those 250 people obviously don't have jobs anymore. So automation and innovative manufacturing technologies, for example, has surpassed and obviously supplanted employment as well.
So what sectors should the government be focusing in on to create jobs? If the government has these big and ambitious goals in terms of job creation, which sectors within the manufacturing space would be the best ones to focus on?
I think typically what we have seen is manufacturing services. So anything related to services within the manufacturing sector is typically much bigger job creators. Pure automation, for example, we've got assembly plants. They're actually not big job creators in their own right.
But we are focusing on that sector, of course.
So what typically happens is in the first phase is initially a lot of jobs being created as plants have to be built, engineering, etc. Once those plants are in place, because of the level of automation, we don't need that level of sort of employment levels to be maintained. But related services is probably where the key focus should be.